And I want to start off on volatility first and foremost, because that's the new thing that's been introduced to the markets in 2018. In fact, in 2017, the biggest drawdown that we saw throughout the course of the year was 3%. And we've already had two 10% corrections this year alone. So a key question, is volatility returning back to the market for good? Michael, what are your thoughts? Do you think volatility is going to continue to rise from here?
Absolutely. I do believe, as Scott does, that volatility is to stay with us. On the international side, we have a few things more to worry, just about, not only about the Fed. We do have the slowdown in China. We do have an Italian budget discussion, and we have Brexit. So let's go from the back to the front. So Brexit, we have a withdrawal agreement decided by the EU 27 already. Theresa May agreed on that too. But the real problem is to get it through the lower house, and that will happen in the next weeks. It might not pass in the first run, might pass in the second run, but that is the deal the EU would offer, and I think there will be no alternative to that. Otherwise, we have a hard Brexit, which I personally do not believe in. So then Italy, there is a populist government in place right now. They are on confrontational course with the EU, with the European Union about their budget proposal. And here it looks like that we come to a kind of compromise. The governments have signaled that they would not be as stubborn as they have been originally. And China, which is for me on the international side by far the biggest issue. The trade issue hopefully will ease up a little bit. We have the G20 meeting coming up, and I hope to get some positive news on it.
Michael, any thoughts on trade tensions?
Well, I'm not super bullish on the G20 meeting. I just have to rephrase that a little bit. So therefore, so from my point, just a little bit of an improvement, a delay of the 25% to a later point would make markets already move, because the markets are so sensitive what the relation is between the United States and China. And for us on the international side, it's even more important, because when you think about it, China was a growth engine over the last 15 years for the world economy, and in particular for the international markets. Because they were the major consumer of resources over the last 15 years. In some cases, they made 50% of the entire demand for certain resources, which helps certain emerging markets, but also some of the developed markets like Canada or Australia, which are very resource-driven. And then, if you build up the entire production chain in China, I mean, you were buying goods from whatever, from Germany or Europe in general, from Japan, South Korea, and so on and so on. So therefore, the impact is much, much bigger. So if you were looking at United States to exports to emerging markets, is only half what Europe would be, for example. So far, the impact were not as massive. We're only a few tenths of a percentage point in terms of GDP growth. But the sentiment is the critical part, right? So originally, we were thinking about, because utilization rates are relatively high by now, that people go into CapEx spending. And CapEx spending actually hasn't really happened as we were originally forecasting. And I think the sentiment is what brought international markets down this year, together with currency.
So we've talked quite a bit about the U.S. markets. Let's move over to the international space. So let's talk about earnings trends in Europe, the UK, Japan, and will valuations catch up here to the U.S.?
Europe had already several downgrades over the last quarters, in particular in the last one. So, and the ECB policy overall, the stimulus in Europe started much later than in the U.S. So the benefits of all this QE program is coming later in Europe and in other regions as well. So IBIS is forecasting for next year actually around 10% for the Eurozone, and then 9% for the year after. UK in a little bit difficult situation because of the Brexit situation is more thinking about 7, and then in 2020 for 5. And Japan is a very slow growing economy anyway to start with, is somewhere around levels around 7 for 2019, 5 for the year after. So the ones which are in double digit over both years are emerging markets. So that's what IBIS is saying. And I think critical to see when this whole trend is turning is looking at revision ratios. So if we have upgrades versus downgrades, and right now we're in below 1, meaning we have more downgrades than upgrades. And this is exactly what we talked about, the sentiment issue, right? I mean, all of us agree on that for sure. And it looks like that we have to watch when it's bottoming out. Europe had a really tough time over the last few months. Could there be a bottoming out somewhere? Yeah, perhaps it's possible. So, but that would be more a 2019 story rather than the end of 2018 now. So the second part of your question was, can international markets valuations catch up with the US? So that would be, I think it would be kind of wishful thinking if that is going to happen. Historically, the US was leading in terms of overall valuations. But there are also certain reasons to that. One is clearly the composition of the index, like S&P 500 has much more technology in there, much more high growth, whereas most of the other indices worldwide are a little bit, some of them are actually value oriented, some of them are a mix of this. So the other part is what the US always had over international market. They had a much higher ROE, return on equity. So and historically it was around 5-6%. That's where we are currently as well. Part of that is because it's higher growth, they have less equity as a growthy environment. But the other part is actually that the US really done it very smartly and levered up their balance sheet. Did share buybacks, put additional debt on the balance sheet, bought equities back, reduced the equity exposure, and got a higher ROE just via that measure. So could international companies do the same? The answer is yes, it could, because when you look at balance sheets of international companies, if you look at a 30-year average, in Europe, for example, we are below 30-year average. US, we're above, clearly above. Japan, we're on historical lows. Actually, we have a lot of company with cash, and it's sitting there and it's diluting the ROE. And with higher ROE, you get, of course, higher valuations. The other part is cash flow. US companies have managed their cash flows always better than international companies. That is, working capital management and so on. Could international companies catch up a little bit? Yes, I think that's possible too. But will there be always a gap? Yes. The international markets had a very, very deep crisis, the deep financial crisis, and they're in general a little bit more conservative, and they need a little bit longer to improve and then feel comfortable to do share buybacks.
And Michael, you mentioned the composition of the indices being different, US being more growth-oriented, Europe, Japan being a little bit more value-centric. We actually have done some work on this, and we normalized, so you had the same amount of IT exposure in the US versus Europe. And even when you normalize the two markets, the US is trading 1 PE higher than Europe. So that would actually bode, if you do see a turnaround in Europe, maybe some potential higher valuations, broadly speaking. But one of the reasons why I think Europe and international markets could turn around is because of liquidity, right? Central banks still have their foot on the accelerator abroad. Sorry, Michael, Margaret put you on the spot there that you had some comments on the US dollar.
Right. Yeah, for us, it's the currency is super, super important because at the end of the day, the total return for our shareholders is a combination of the local stock markets and the return on the currency. So 2017, as you said, Jeff, we had a fantastic year. 2018, we have headwinds from both sides, local stock markets as well as from the currency. So question mark is what will happen to 2019. And I just want to go through a few little pieces which could determine which direction we are going. So one is more a technical thing. So positioning in this whole risk off mode was clearly we will go back to the US dollar from foreign currency into US dollar. We are today, in terms of long positions, speculative long positions, US dollar close to all-time highs. So if you are the contrarian view, you would be on the other side, right? You would be short the dollar at one point in time.
Which is what markets were coming into 2018.
Yeah. So the next step would be what happens to interest rate differentials. So somewhere at the beginning of 2019, we probably will see the peak of interest rate differentials, for example, like US dollar and euro. So we are at different stages, as I said earlier, in terms of central bank policy. So in the US, the Fed has finished QE already. We are in quantitative tightening mode, as you said, Scott. In Europe, we are still in quantitative easing mode until the end of this year, and we'll stop QE beginning January 1st. But that doesn't mean that liquidity will get tighter in Europe. It will actually, the central bank, the ECB, will continue to give enough liquidity, and one which I would expect in quarter one or quarter two which is a facility for the banks, which is called TLTRO, and that will be given because the old ones are running out and they want to make sure that there's enough liquidity in the system. So I think that would be one. So from the liquidity side, I think the ECB will be easy for almost for the whole year 2019. We'll start the first little increase towards end 2019, but that is out of negative territory into still negative territory. So 2020 we will see the first time positive interest rates in Europe. That's at least what consensus here is building into the forecast curves. Bank of Japan was very easy so far, and it looks like it will continue. We will still be around the zero level, and liquidity is still ample. So we still get the green light, Jeff, on central banks internationally. And China, perhaps we talk about that later, but they are back to QE from tightening, and that also brought the Chinese market down because they took liquidity out of the market. Credit growth was slower, clearly slower, and is coming back with their measures they took just recently. The other part is, when I look at currencies, I look at GDP differentials. So here, clearly, the US was the rock star again in 2018. Going forward in 2019, 2020, we are converging. The US will still leading, but the gap between US and Europe or Japan will close a little bit. And emerging market, interestingly, I think could accelerate if we are not going in a totally full-out blown trade war, which I do not hope for. And then the other ones are a little bit more on the current account deficit in the US, which is pretty high. The US has to issue a lot of debt in order to finance the tax cuts, which we have seen here in 2018 going into 2019. So could that be also slightly negative for the US dollar? So the more we go into 2019, to sum up that point, is the more we go into 2019, I could see that the US dollar starting to weaken again.
US dollar obviously is one of the reasons why the US has outperformed most other global markets in 2018. What makes you optimistic about the potential returns for international developed markets and then also emerging markets like China as well? And I'm going to start with you.
It's me again. Okay, good. So let's start with positioning first of all again. Clearly, with the kind of risk-off mode, people just sold emerging markets first, Europe second, and this money went into either different asset classes, but all of them US dollar denominated. And the only country where we have really seen inflows was Japan. So being contrarian again, that would be a positive for international markets. The other part is actually valuations. I don't want to look into in terms of absolute levels of PEs or price to books. I prefer actually, because the valuations are always lower in international markets, to look versus history of the respective regions. So if you look backwards 30 years, you see that PEs, and it's similar to price to book and other measures, that Europe is roughly 7% cheap over 30-year average. The emerging markets are currently 15% cheap. And Japan, if you were doing that exercise, is actually 45% cheap. So that sounds like a lot for Japan, but it's because at the beginning we had extreme high multiples. We just came out of the bubble of Japan, which is lifting the overall average. So, but even if we were doing that over a shorter period of time, even Japan looks relatively cheap. So that is the part of valuation. So central banks, I elaborated a little bit before, so liquidity is there for the ECB. And Europe, it will be the case for Japan. And the big one for us on the international side is China. So China itself has done several things over the last months. Being pretty tight in 2017 going into 2018 because they wanted to make sure that there is not too many of the bad loans that were restrictive. So 2018, with the whole trade war, they started to go the other way around. They used one measure which is called the RRR, which is the Reserve Requirement Ratio, which basically allows banks to lend more for the capital they have. So they have done already 150, 100 are in the making, so we are talking about 250 basis points, which is a lot. The Shibor, which is the short-term rate, which went from 5 to 3. We had like overall financial condition ratios, which are, as it's just a chart which a lot of people use, went from 75 to 90, 90 being higher, being more easy. So what it does, it should lead to higher M1 growth. It should lead to better overall growth in the economy. But in there is the banking system, and the banking system has to give more loans, and that has not really happened to the full extent as it did in the last cycles. So then the next part would be, how do actually the different parts of the economy do? Consumers are doing actually fairly well everywhere in the developed world. So we're talking in Europe, for example, we have already shortage in terms of skilled laborers in Germany and other northern European countries. We have wage growth around 3+% already. Japan, we are so tight in the labor market that applicant ratio to open jobs is skyrocketing. Also, even in Japan, we see wage growth. So the consumer is actually doing fairly well and was never really that leveraged over the last years. So that's a good thing. Then we have the corporate sector. Corporate sector is also doing relatively well because they have not put that much debt on it. And as I said before, we're below 30-year average in Europe, and we're at rock bottom in terms of leverage, meaning actually cash, in Japan. So from that perspective, the base is actually relatively good. What we need is, clearly, we need better sentiment. And sentiment, I think trade could be one, and hopefully we will postpone the kind of 25 or we'll reduce it a little bit. Although I do agree with you, Margaret, will be on technology, the fight will continue. I mean, and that the Americans will push for patent preservation and protection. So I mean, I think that will continue for many, many years to come. But what I'm talking about, which should lead to a little bit better sentiment, is the edges that they come for certain goods, which I could agree on. I mean, that's what I would like to see.
Well, I think we're up on time. I appreciate you all joining me in the studio here today, but I want to just leave the viewers with one key takeaway. If there's one thing that you want the viewers to think about, what's likely to transpire or keep in front of their mind for 2019, what is it? Michael?
All right, it's always good to be third because I don't have to talk that much. So, Margaret, thanks for diversification. That also applies actually for international stocks. Thank you. So it's not only in terms of sectors, but it could be also in terms of regions and currencies and so on. And I know that a lot of investors have a bias towards home. I mean, that's also understandable because, I mean, their obligations are normally in US dollar. But, you know, putting a little sliver of international here and there wouldn't hurt for the reasons which I was mentioning. Scott, I do agree with you that quality is probably the main focus if we're in the later part of the cycle. I think that also helps for us on the international strategies because we have a quality focus. And I think what investors have to, in these kind of volatile times, have to be very valuation focused. So, and what we try to do in our international strategy is that we have a very strong valuation approach to growth. So we're not want to overpay for growth. If the stocks are coming down, gives you buy opportunities, and that's what we are trying to do. And I think what investors should do as well, you know, using some of the dips in quality stocks and focus, even if the sentiment is sometimes a little bit bad, but that's normally the time when you look at the stocks.